The $3.2 billion takeover of Credit Suisse by its rival UBS averted bankruptcy for the Swiss banking giant. The bailout of Credit Suisse follows the second and third largest bank failures in US history. The turmoil started with the fall of Silicon Valley Bank. A year of interest rate hikes was one factor behind its collapse. But experts say the era of historically low interest rates could be over.
The bigger issue, which I think we all should think about, is that after, 15 years of extraordinarily low interest rates and I think very easy money, and with financial participants, sort of assuming that the Fed and all would always come in to backstop investors if financial markets came down, we had a completely new financial regime, new asset pricing regime. Interest rates are going to be higher for longer. Cost of capital has gone up. Risk is now being priced much more rigorously. And that means that a lot of the excesses, speculation, imbalances, perhaps misjudgments that accumulated over the period of very easy money, and which were covered up by that provision of easy money, are now going to be reversed, unwound, and some of that is going to be very messy.
The banking crisis has added to fears of recession. Amid such jitters, all the experts we spoke to agree on the key strategies for investors.
For all investors, one thing that they have to remember is diversification. So especially in this environment, cash is also king. So I think investors would do well if they remember these broad guidelines, meaning you should have a certain amount of your money in cash equivalents. You could consider maybe, even the T-bills that the Singapore government is issuing. Second thing, to have equities. So within equities, you could actually look at both growth and also quality. And lastly, in case there's a recession, you should actually have also investment-grade bonds, because when you do have a significant economic slowdown, central banks would likely cut interest rates, and that would be positive for bond prices.
Investing is about buying and holding good quality companies and actually buying more of them when their price goes down. And I suppose the only problem today is that prices have not gone down a lot. So it hasn't been that big of a sell-off. Buying and holding, not trading, is the way to invest. And just realize that share prices don't go up in a straight line, but over time they do.
Our aim is for investors to stay very defensive. We are in the late part of the business cycle. We are in autumn. We are preparing for winter. And usually fixed income is the way to go. And by fixed income, there are many parts in fixed income. We are looking into moving towards more into government bonds for the safe haven assets. Investment grade, good corporate bonds are okay. Try not to touch the high yield bond sector, because the high yields will be impacted by credit rating downgrades, particularly when the recession hits. Otherwise, within the equity space, do look into some of the defensive sectors. The usual ones are your consumer staples, your utilities, healthcare, and interestingly, some of the oversold growth stocks in the technology sectors, but good, strong technology sectors, those are still of a very good value. Otherwise, I will be looking into gold as a safe haven asset as well.
Investors can also consider longer-term themes.
A direct play at this moment would be the Chinese equities market, and a secondary play could actually be a China plus one story, which that then includes India and Vietnam. There are also other themes out there that could be more thematic in nature. So for example, ESG. Investors could be looking for companies that benefit from the policy tailwinds of ESG. And even for technology, currently there's this excitement about ChatGPT, about generative AI.
If you're looking at financial investments in financial markets, then not investing in a single company or a single country or a single sector, but really trying to be more diversified across global markets. Also, I think making time your friend is really important. So those institutional investors who have long-term investment minds don't really focus on short-term returns. And the market is quite efficient, but in times of crisis, it can be inefficient, and there's a lot of mispricing in markets. And therefore, having a long-term mindset allows you to pick up value investment opportunities that will give you good returns over the long term, especially in times of crisis.
The recent failures of financial institutions have also sparked concerns among customers about their cash deposits. But analysts say that money kept in banks is generally safe.
There's this insurance scheme over here in Singapore, so up to $75,000 you'll be insured. The banks over here in Singapore, regardless of whether it's a local bank or it's a foreign bank, the regulations actually applies to them. So, so we are confident that the banks in Singapore are basically safe.
Maybe the money market fund is a good alternative for you to invest in. Because money market funds obviously are mark to market every day, has daily liquidity, no lockup. So those are attractive like liquidity management, cash management solutions, and they represent almost 20% of bank deposits in the US. So it's a very popular, common way to manage your liquidity if you're concerned about bank deposits.